Hello friends, welcome to my YouTube channel Sudhir Encyclopedia. So this channel is specifically designed for different subjects, direct tax, indirect tax and any related topics in audit, also quantitative aptitude reasonings, everything. This channel is specifically designed for every subject. Okay. So our today's discussion is on goods and service tax. Okay. And this video is specifically for the beginners, those who do not have any idea regarding GST. And after seeing the video, they will get a concept what is GST, how it works, what is the definition of GST, how GST liability is discharged, means what is output tax liability, how ITC they availed, what is ITC, what is input tax credit, how it is availed, how it is utilized. That is the specifically designed study material for the beginners, and it's part one. So it's for beginners, and it is specifically helpful for those who are preparing for SAS and RE exam, which is conducted by Indian Audit and Accounts Department, and also students and professional in the relevant field can get the basic concept here. Okay, and it's imperative nowadays to know GST. Okay, because it is a consumption based tax. We are paying the GST. So we are paying the GST means we have to know what is GST and whether the tax we paid it's right or wrong, whether the trader, whether the taxpayer had collected the right amount from us or cheat us. So as a conscious citizen, we have to know. Okay. So if you watch the video till the end, definitely you will get a understanding regarding the fundamental of GST in India. Okay. So let's start. GST explained for beginners part 1. How GST works from supply to tax payment. How GST works from supply to tax payment. Because supply is the cornerstone. Supply is the first point on which levy of taxes arise. Unless and until there is a supply, the GST cannot be arise. Okay, levy of GST cannot be arise. So supply is the first point. Okay. So define tax. Very simple thing in one line. What is tax? Tax is an enforced contribution exerted pursuant to legislative authority. The key word is here is pursuant to legislative authority. Means it is neither a voluntary contribution or a donation. So whatever we are paying, what tax we are paying, whether it is income tax, GST, anything else, everything is on the basics of a legislative authority. Everything is on the basics of a act made in the parliament. Okay. Then Article 265 of the Constitution provides that no tax shall be levied or collected except by the authority of law. Okay. Without any authority, no one can collect tax from you forcefully. Definitely there is a authority, legislative authority. And in the act everything is prescribed. Means what is the tax rate? We are paying the GST, what is the tax rate? But we are paying the income tax, what is the slab? Okay. The tax rate, income tax rate for senior citizen. Then everything is prescribed in the act. Means the rate of tax, return filing, payment due days, interest penalty, compliance requirement and grievance redressal mechanism. Means what is the rate of tax? First thing. Second thing is what is the due date of filing the return? If not filed within the due date, what is the payment of interest and penalty provision? Okay. And if we have some grievance, near which authority will make the appeal? Okay. Suppose you just see, suppose a big taxpayer paying 500 crore GST per year. Suppose the tax authority, the proper officer, while auditing the taxpayer, issue a demand of 100 crore. So it's not bound for the taxpayer to pay the amount instantly. If he thinks that, and if he if he thinks from legal point of view, the demand is not appropriate, then he will go for appeal. He will go to the appellate authority, the Honorable High Court, the Honorable Supreme Court. Means there is a grievance redressal mechanism for the taxpayer. Okay. The two type of tax, there are two type of tax: direct tax and net tax. Direct tax means the tax is directly paid to the government while filing the return. Direct tax is a tax imposed directly on the taxpayer and paid directly to the government by the person on whom it is levied, whether an individual natural person or an entity juristic person. Income tax is one of the major direct tax in India. Means in case of direct tax, while we file our return, we paid the tax to the government directly. Suppose when we are filing our IT returns, so directly we will pay the tax to the government. Okay. But in case of indirect tax, the tax is collected and paid through an intermediary. But the burden of tax is ultimately passed to and borne by the consumer. GST is the major indirect tax in India. Your income tax is one of the major direct tax in India, and GST is the major indirect tax in India. In case of indirect tax, ultimately the tax is paid by the consumer. Tax is paid by us. Suppose I am talking about indirect tax GST. Okay. So we are paying the GST, but we paid the GST, the tax, to someone else. We are purchasing a article from a shopkeeper. So we pay the amount to him, and the shopkeeper or trader or the taxpayer, while filing his specific return, he will discharge the liability to the government. Means the tax is paid through an intermediary, through a medium. Okay. But ultimately the tax is paid by the consumer. The GST is the major indirect tax in India. Okay. Definition of GST. Just see it, and in the example you will clearly apprehend what is the definition. The GST is a value added tax. Value added tax means tax is levied at each stage on the value addition. Tax is charged only on the value added at each stage, and business can claim input tax credit for GST already paid. This removes the cascading effect, tax on tax effect, so the final consumer bear the tax, making GST a destination based consumer tax. Okay. While seeing the example, you will apprehend the concept very clearly. Then just before this slide, what is the objective of GST? Simple in one line, the purpose of tax is to raise revenue for providing public service and welfare measure to the people. Whatever tax collected by the government, that is a source of revenue for the government, and out of the revenue, the government do some welfare works. Okay. The taxable event under GST is the supply of goods or service. I said you, the taxable event means the first point on which GST arises is supply. So that is the taxable event. Intrastate supply. What is intrastate supply? Intra means within the state, same state or UT. When the transaction is within the same state or UT, a transaction happened in Odisha, means suppose Bhubaneswar and Cuttack. The transaction is within the state, so it's intrastate. In case of intrastate, CGST plus SGST or UTGST arises. Inter means between two states, between different state or UT, between two different state or between a state and UT. Okay, suppose Odisha and Maharashtra. Transaction supplier is Odisha, recipient is Maharashtra. It is interstate sale. Okay. Here in case of interstate sale, IGST arises. Then import of goods, export and supply to SEZ are treated as interstate supplies and are governed under IGST. In GST, every import, export or supply to SEZ, SEZ means special economic zones. It is a designated zone, okay, which is in the country, but it is a specialist designated zone in which normal trade law of the country is loosened up to certain extents or not applied. Okay. Just listen this thing, just remember these things. It is a designated zone in which normal trade law of the country is up to certain extent relaxed or not applied. So supply to SEZ is zero rated, means if you supply to special economic zone it is zero rated. So simply trade law is something different in case of supply to SEZ. In the language of GST, SEZ is treated as a foreign country. Okay. So here SEZ. So import, export and supply to SEZ are treated as interstate supplies and govern under IGST. Clear? So when does GST arise? Now GST arise on supply of goods or service or both, therefore taxable event under GST supply. I said you GST arise on supply of goods or service, means whenever there is a supply, levy of GST arise. The taxable event under GST is a supply. Every supply involves two parties. One is a supplier, the person who supplies the goods or service. Then second is recipient, the person who receives the goods or service and pay the consideration. Once a taxable supply takes place, GST is levied on that transaction. Okay. Once a taxable supply takes place, GST is levied on that transaction. Clear? So before I'll tell you regarding output tax liability, input tax credit, you just know the prerequisite concept, credit ledger, which is called electronic credit ledger, means our input tax credit ledger. So in the next slide I will tell you output tax liability, input tax credit. You just know the two prerequisites, electronic credit ledgers. So while you purchase input tax credit is arise. Suppose I am a retailer, I purchase a goods from a wholesaler. Suppose I purchase a goods from a wholesaler. The price is 1000, tax rate is 18%. I pay him 1000 plus 18%, 180, and the wholesaler will discharge the liability. What it takes from me, he will discharge the liability to the government. Okay, and what I paid to him, that is a input tax for me, and that input tax is credited to the ledger. That input tax is credited to the ledger. Okay. ITC arise on purchase, liability arise on sales. He sells me, he takes 180 rupees from me and he will discharge the liability to the government. Whatever liability discharged to the government, that is a input tax credit for me and that is credited to my ledger. Means ITC arise on purchase. When I sell it to the consumer, I will set up the credit. In the example, you will apprehend better. Okay. So electronic ledger records the eligible input tax credit ITC arise on inward supply purchase, which can be utilized to set up eligible output tax liability. It is just a dummy credit ledger. Let's say ITC availed on purchase 50,000, that is credited 50,000, it is ITC credited. ITC utilized 30,000, means when utilized it is debited to the credit ledger. In purchase ITC is accrued or it is credited, and while you set up the ITC it is debited. ITC utilized 20,000. Okay. Then second thing is cash ledger, means there are two ways in which you discharge the liability, white cash component and white ITC. So when you discharge the liability in cash component, you must have a ledger in which you deposit the amount. When amount is deposited, cash ledger is credited. When you utilize, cash ledger is debited. Clear? A ledger that records the amount deposited in cash by the taxpayer which can be utilized to pay tax, interest, penalty, fees or any other amount payable under GST. So in certain cases you will discharge the liability in cash component. There is a specific component in which it is mandatory for you to discharge the liability in cash component. Suppose there is a term RCM, reverse charge mechanism. It's not a part of the video, but RCM liability is discharged in cash component. If the taxpayer have any interest, it will be paid in cash component. That's why there is a cash ledger. In cash ledger, when you deposit the cash, it is credited to the ledger. When you utilize the cash, it is debited to the ledger. Here you see output tax liability and input tax credit. Output tax liability, the GST charged by the supply on the outward supply of goods or service is called output tax liability. I am the supplier. I sold an article to you for rupees 1000 and tax of 5%, say it 5%. So you paid me 1000 for 5% of tax means 50 rupees. The 50 rupees you paid me. So I will discharge the liability to the government while filing my return, and that 50 rupees is my output tax liability. I collected from you and liable to deposit it to the government while filing my prescribed return. Clear? The output tax liability arises on sales. Sales. Who sells? Whatever he collect from the recipient, that is the output tax liability for him, and he discharge the liability. It means output tax liability arises on supply. In simple words, it is the tax that the supplier is required to collect from the recipient and discharge the liability that is paid to the government while filing his periodical return GST at 3B. Simple thing. I sell to you and I get the collect the tax from you. Whatever the tax collect from you, that will be paid to the government, and that is the output tax liability for me. I will discharge the liability to the government while filing my GST return, specified return, that is GST 3B. GST 3B is a return on which you will discharge the liability. It is the month return. Then input tax credit. Input means it's an input for you. Input means when you purchase, when recipient pays a GST while purchasing goods or service for business purpose, this GST paid on inward supply is known as input tax. I purchase a goods from you. Same example. Suppose you are the recipient. You purchase, I supply the goods to you. 1000 is the taxable value, 5% is tax. So you pay me 50 rupees tax to me, and I will discharge the liability. Whatever tax you paid to me, that will be credited to a ledger. It is a input tax credit for you. And when you, in the course of furtherance of business, you will set up the credit. Whenever you purchase, the tax which is paid by you is credited to the credit ledger. Okay, and that will be set up later. Under GST, the recipient can claim the GST paid on inward supply as input tax credit subject to prescribed condition, which is credited to the electronic credit ledger and can be utilized to set up the output tax liability in the course or furtherance of business. Okay. Claim of ITC is on prescribed condition, means claim, there is a certain condition on the basics of which you will claim the ITC. Means you purchase, means definitely you have the invoice and you receive the goods. Okay, so that condition, if the condition and it is used for the business purpose, and if this is the condition, that is a separate chapter, then you will claim the ITC. And that ITC will be utilized to set up output tax liability in the course of furtherance of business. This is the vital thing. If you see the example, if you apprehend the example, then it will be better for you to understand the facts. Okay, unless and until you see the example, you can't apprehend. means you can apprehend completely. Suppose I said levy of GST is on the basics of a supply. Unless and until supply takes place, GST cannot be levied. Here the example, if a supplier A, here A is the supplier, okay, sells goods worth 10,000 and GST is 18%, the supplier will charge 1800 as GST. Okay. A sales of goods worth 10,000 and GST 18%. The supplier charge, what is the GST amount? The 1800 as GST. The value of goods is 10,000. Value means taxable value is 10,000, and the taxable value of goods is 10,000, GST at the rate of 18%, 1800. What is the invoice value? 1100, 11,800. Here 1800 is a supplier output tax liability. Supplier sells the goods to the recipient. Supplier sells the goods to the recipient. Supplier is A. He sells the goods to the recipient worth 10,000. Worth 10,000 means it is taxable value, and GST is 18%. The supplier will charge 1800 as a GST. Taxable value of goods is 10,000. GST at the rate of 18% is 1800. Invoice value is taxable value plus GST is 11,800. Here 1800 is the supplier output tax liability, means whatever tax is collected from the recipient, that will be discharged, that will be paid to the government while filing its periodical return. Okay, clear? This example is continued. The recipient B purchased goods for 11, the same example. The recipient B purchased the goods for 11,800 including 1800 GST. The recipient claimed the ITC of 1800 which is credited to his credit ledger. I told you here both the recipients, both the supplier and recipients are GST registered person, means they are doing the business. They non is means B is not the ultimate consumer. Means when B purchased the goods and paid 1800 GST, that 1800 is credited to his credit ledger. Okay. The ITC arises on purchase, and that 1800 is also discharged by the supplier. Okay, and this is the amount which is credited to his credit ledger. Credited to his credit ledger means which is already paid to the government by the supplier. Supplier's output tax liability is equal to the recipient input tax credit. That amount has been paid to the government. Already the government has get 1800 as tax. First supply chain. Then later the recipient sell those goods and charge 11,000, value addition rupees 1,000. Then finally B sell the goods to C. C is the final consumer with a price of 11,000. Here he purchased it 10,000 and added value 1,000, 11,000. He sells it at, he sell it as 11,000. Charge the tax at the rate of 18% means 1980. The GST payable to the government will be, what is the GST payable to the government? Means output tax liability. What he collected from the consumer is his output tax liability. He has to discharge the output tax liability. Finally, the consumer gives 1980. Means what is the GST payable to the government by B? Now output tax liability minus input tax credit. Output tax liability is 1980 minus input tax credit, means which is credited to his ledger. He set up the input tax credit. The value added tax is collected at value addition at each stage, and there is a set of facility. First, if you go from the first, A sells to B at 10,000 and GST is 18%. So final price is 11,800 and the output tax liability of A is 1800 because he collects the tax from the recipient and he discharges the liability while filing his periodical return. And these 18 rupees is credited to the credit ledger of B because he paid rupees 1800. What is credited to the credit ledger, that has already been discharged by the supplier to the government. And B, add value of 1000, finally sold it to the final consumer at 1100, and charge of tax is 1800. The tax is 1980. That 1980 is paid by whom? Final consumer. So your definition come here. GST is a consumption based tax. Finally the tax is paid by the consumer. Who paid the final tax? 1980 is paid by the consumer. Then what is the tax to be paid by B to the government? Already the government has get 1800 as a tax. Now B will pay the output tax liability minus input tax credit. Okay. The GST payable to the government by B will be output tax liability. What is his output tax liability? Now what he collected from the consumer minus input tax credit, which is credited to his ledger. The 1980 minus 1800 means this 1800 is he set up the input tax credit. That credit is set up. The here definition come. Tax is collected at value addition at each stage, and there is a set of facility. The final tax is paid by the consumer and be paid to the government. 1980 minus 1800, this 1800 is set up by B, which is already paid by A. 180 paid through cash while debiting the cash ledger. 1800 is set up, means he used the ITC ledger, and 180 is paid through cash, and final tax is paid by ultimate consumer. ITC of 1800 utilized where set up the liability while debiting the credit ledger. Okay. So here conclusion is GST is a destination based consumption tax, as the total tax of 1980 is paid by the final consumer. Final consumer C. Okay. Then business act as intermediary by collecting GST on outward supply and remitting it to the government. Means business act as intermediary. Means he collect the tax from the final consumer and discharge it while filing his periodical return. The input tax credit mechanism ensures that tax is levied only on the value added at each stage. The tax is levied only on the value added at each stage of the supply chain. ITC available in the electronic credit ledger of B 1800 can be utilized to set up the eligible output tax liability in the accordance with the provision of GST law. ITC paid in cash component by B is only 180. Means he set up 1800, which is credited to his credit ledger while purchasing it from A, and he set up the 1800 and paid cash component 180. Finally the 1980 is paid by the final consumer. The government get, what is the tax amount the government get? Now initially it get 1800, and here the cash component 180. 1980 government get, and that is paid by the final consumer. Clear? So here the core concept. It is also important to understand that availment and utilization of IT are two separate and continuous process. Means what is availed means when the ITC is credited to the ledger, when you purchase something, whatever tax paid by you to the supplier is your input tax credit, and when it goes to the input credit ledger, it is availed. Availed means it is in your ledger. You availed it. You just claim it in the ledger. Credited to the ledger. Utilize means when you set up the ITC, which is in your ledger, while discharging your liability during the course of furtherance of business, that is called utilize. Okay. So there are two different tables in GST 3B. In which table he availed the ITC and linked to the ITC credit ledger, and which table he utilized the ITC. Okay. ITC availed on a particular inward supply is not required to be utilized only against the tax arising from that specific goods or service. Means think is that whenever I am teaching some students, they just ask me question whether the ITC on a particular product is utilized for that particular product. No, it's a common pool means you just purchase and ITC is available to your credit ledger. You can utilize it while discharging your liability in a month. Okay, that this ITC is maybe for the same goods or other goods. Means its ITC is a common pool which is credited to the ledger, is a common pool that can be utilized while set up the liability. ITC available on a particular inward supply is not required to be utilized only against the tax arising from that specific goods or service. Once credited to the electronic credit ledger, ITC form a common pool and may be utilized for payment of eligible output tax liability. Okay. Subject to the order of utilization and other provision prescribed under the CGST and IGST Act. Okay. So, what is ITC availed? What is ITC utilized? Specific return GSTR 3B table in which ITC availed, in which ITC utilized. What is the order of utilization? Rule of utilization means ITC availed means you availed CGST credit, SGST credit for interstate supply, and for interstate you availed IGST, and there is also GST cess also. Okay, so there is a specific rule under which ITC setup is established. Means which credit is utilized for whom. Suppose which credits is only set up for this ITC. This ITC credits is only eligible to set up for this liability. So there is a specified rule. In the second video, you just see my second video, part 2. In the part 2, I will give a detailed difference between ITC availed, ITC utilized with GSTR 3B return specified table so that you will completely understand the things, and you see the example. If you apprehend the example, then you will definitely understand the logic behind GST. Okay. If you will not apprehend the example, it is very difficult for you to know the basic facts. Okay. So details in this regard will be discussed in the next video. Please see my next video also, that is part 2, and then we'll go to different topic, registration, other things, but it's for beginner. You just apprehend these things, then it's easy for you to know the other things. Okay, so thank you very much. So I ask all the students, all the professionals, all the officials, those who are watching the channel, please give your suggestion regarding the video and regarding the content, and please tell me frankly which type of video you needed. I will come with that type of video. So don't forget to like, share and subscribe. Thank you. Have a great day. Thank you.